All here. Okay. Good afternoon and welcome to another session of Valor Financial Specialists here to cover a very, I don't want to say controversial topic, but a topic that is often talked about. It is premium finance. Really, the goal for today is to uncover the mysteries of premium finance. Really, we want to look at the idea of what is it, more importantly, what is it not? Because there are a lot of people out there who mystify this product, and personally, I believe do not sell it in the appropriate manner. So we want to make sure that we're selling it in the right context when it is opportune for our clientele. How does it work? The pros and cons, and then really what are the requirements to do something like this? And then we'll look at a couple different types of ways that you can do premium finance. Call it baby premium finance or traditional. And you'll see why I say that as we go through this process. So let's first start off with what is it? What is the idea of premium finance? Well, the whole idea behind it is a bank is letting you use their money, so it's leveraged money, for a person to fund an insurance policy premium. Now, we're not talking about term insurance. We're talking about cash value based life insurance policies. Why? Because they want to use the ability to leverage this asset. So typically, you find this to be higher net worth individuals, where they're going to pay premiums on larger life policies. So these people, think in mind what type of people this could be. People who are maybe property rich and cash poor, per se, or they have their assets tied up in other things that are giving them double digit returns that they don't want to put their money into a life insurance policy at this point because it's not giving them the type of returns they're looking for. But they do know that they need the coverage. The most important thing about this is the client understands why they need life insurance and why this could be a good vehicle for them. The downside is that when you deal with our type of opportunity here, you're dealing with a lot of high net worth individuals. What does a lot of high net worth individuals mean? A lot of higher premium type products, a lot of higher commissions. And so that leads us into what is it not? A lot of people will lead in or tie in the idea of free insurance, that if the client pays the least amount possible, then they get the bank to pay the most amount possible. It's pretty much free insurance. The problem is there's no such thing as a free lunch. I'll show you in some examples later in this presentation exactly what I mean by that. But the whole idea is this product, and the carriers are aligned with this, will not push a product through or an insurance policy if you are saying, how is this designed? And you say free insurance. It should never be designed for free insurance. This should be a vehicle as to get someone the policy that they need or the desired face amount that they need, not the how much can I get for this type of scenario. It's not a means to fund life insurance when the ability to pay doesn't exist. I've had several people in the past, once again, use the scenario of how much can I get for this? All right, if I can't get approved for 10 million, can I get approved for 5 million? What about 1 million? And they go back and forth to try and see how much can the client quote unquote afford. But the problem once again is that your client should have an understanding or desire as to why they need the coverage. By all means, this is not a simple strategy. When you think about everything that's involved, you have banks, you have insurance companies, you have exams, you have to get third party financials, usually authorized or audited by a CPA. So when you think of all of this stuff combined, it is not for the brand new agent to come out and say, oh, I'm going to start selling premium finance. There's a lot that goes behind the scenes as to how this works. So once again, It's not a method of selling life insurance to a client who doesn't have a need for insurance. So typically, when you do a premium finance case like that, usually by about the third or fourth year, the client questions why they're doing it and usually stop, which could lead to chargebacks or other concerns for you, including lawsuits and litigation. So that's what we want to avoid in all of this. And usually, when I talk to someone about premium finance, I'll downplay it so much that if they still want to buy it, they understand all the risks that are involved in it. How does it work? They typically take your, let's use an index universal life, for example's sake. You can use this with whole life as well, and max fund the policy. So you're not talking minimum or target premium. You're talking the guideline level premium max. Now, it used to be like 4 or 5 years, but the strategy, because of the current interest rate environment, is now up to 10 years. So you usually don't see anything below 10 years for this type of strategy. And what happens is the carrier utilizes early cash value riders so the client doesn't have to pay much in collateral with the bank that they're using for traditional premium finance cases. And what you're really doing is the easiest way to say this is you're taking a mortgage out on your life insurance policy. So the policy owner obtains a loan from the bank, loan interest accrues. And when you talk about the actual interest, the interest has to be paid back along with the principal at some point. That is where you're using the cash value from the life insurance policy to pay off that loan that you borrowed. While that money is accumulating, the loan balance is collateralizing. What does that mean? If I borrowed $100,000, the cash value inside the life insurance policy was, let's say, $80,000. I have a $20,000 gap that if I surrendered my policy today. So you need to have liquid $20,000 sitting in the bank to cover that gap that if you surrender your policy today, the cash value plus that collateralized loan will pay off the note that you borrowed. Now that's short, like smaller policies that typically aren't premium finance. Because once again, when you think premium finance, the premiums are five, six, seven, 800,000 dollars versus 50, 60, $70,000 for traditional premium finance. So you're usually not seeing a collateralized loan of 20,000. It's usually like 100 or 200,000 sitting in the bank. And the cash value is used as an exit strategy to repay the loan. You can't typically with standard premium financing use the death benefit as an exit strategy. No carrier will approve that. So when we think of the pros and cons, the pros, there's more money in the client's pocket. Now, what's the benefit of that? They get more money so they can invest it, they can grow it. It can be used in various strategies. So if you're a business owner and you want to keep your employees, then you have a way where you can give, say, one person a bonus and you don't have to give other ones the bonus. So say, hey, Phil Resch, I'm going to give you a bonus of $20,000 a year. And from that standpoint, I want you to stay. I'll do this for 10 years. You have to put it into a life insurance policy. And then that life insurance policy, you'll get that extra leverage for income. So we'll show you how that works in one of these scenarios here in a minute. It can be used in estate planning as well. So once again, as I mentioned, if you're real estate rich but cash poor, say you own a lot of land, a lot of houses, hotels, whatever, then that's where this type of estate planning, you don't want to sell your hotels at the time of estate planning when you have 9 months to pay off your tax bill, but you don't want to sell a hotel while you're alive to lose that liquidity or growth to pay for the insurance premiums. So some people will leverage a bank and premium finance. So the cons are typically people don't like to deal with an additional invested party being the bank. So the banks have interest rates, the insurance policies have interest rates or illustration rates that can fluctuate and change. So the real big problem, though, is it's traditionally positioned quite poorly from the industry. I'm going to be completely honest, because there are a lot of people out there who are looking for high commission sales. And I've seen illustrations where someone positioned, for example's sake, $1 million a year for 10 years, but the client only has to pay $100,000. That's literally 1% of the total premium that they're paying. And then this client would have a $60 million loan by the time they turn 65. That's crazy given the fact that most of these clients will probably have a high collateral in the seventh, eighth, or ninth year, and excuse me, the fifth, sixth, seventh year, and they'll probably end up not paying for it. Again, it leads to lawsuit and litigation. So that's why I say it's traditionally positioned poorly. That's why I want you guys to understand there are benefits to it, but you have to position it appropriately. Now, us as agents, the downside is that the cash value, because normally these policies have early cash value riders. That means you're going to get paid a compensation over a 4 to 7 year commission spread versus all up front, which we typically get. But once again, if you like that idea of selling a lot of these, and now you get, a 4 to 7 year comp schedule for multiple premium finance cases sold, that's another way to look at it too. So some requirements would, again, when we think about what we're doing here with this, there's medicals, some potentially have non-medical opportunities. That's more of our what I call baby premium finance. In baby premium finance, again, I just use that as a joking term, but it is still your traditional type of premium finance, just slightly different for lower net worths, if you will. But you can potentially get non-medical for up to 3 million with certain carriers that do participate in the premium finance world. What you will typically need is some type of financial documentation or justification. Why? They want to make sure that you're going to actually be able to pay for the premiums. So W-2s, tax returns. If the face amount is large enough, we're talking 10, 15, 20 million, you're going to need third-party financials that are audited and signed by a CPA proving the total worth. And a lot of times, you'll also have to have enough liquidity that if the bank pulls the note, you have the ability to continue paying for it fully. There are always questions on who do you use for a bank or what's needed. We do have 3 different banks that we can partner with, depending on the type of clientele and the type of products. So I have people, if you want to go down this route. But typically, most vendors who do the premium finance will do a 30% comp split for support purposes. And honestly, when you're dealing with this kind of world, that 30% is worth its weight in gold because they usually handle everything from years 2 through 10 or 15 or the entire duration of the contract. So it's a lot of people scoff at that, but I think that's what you call your legal protection against, if the client comes back at you 6, 7 years later saying, that's not what I wanted, even though it is, but they're trying to lie to get their money back. That's where people like that will help and benefit. So the 2 types of premium finance, I joke about it. I call it baby premium finance because it is what we call Kaizen. It is a strategy known by the company NIW. Myself and one of my business partners got to attend their convention in Dallas this past April, May, somewhere in that time frame, and it was great. They told us all the ins and outs on how Kaizen works. For your sake, this is an older version, and I will show you an updated version and how the software looks. But the idea is the same. You have what they call 3-to-1 leverage, where you, as the consumer, are going to put a fixed number in for 5 years, and the bank will match you for roughly 5 years as well. Then after that, the bank will front the next 5 years all by themselves. So as you can see, you have half of the first 5 year payments, they have the other half, and then they front the whole bill for the other 5 years. And in turn, what you'll find is, again, this is older. I will show you a newer one. An interest rate, a hypothetical interest rate that accumulates over time, the total amount borrowed, and then at the end of year 15, they pay the note back with the cash value from the policy. And then at that point, you have the rest of the death benefit that you can use for your leisure. Death benefit, living benefits, because one of their primary carriers has living benefits, and also accumulation. So once again, I'll show you a more in-depth, detailed presentation on this strategy as well, so you can see it. If you guys have not gotten the documentation to sign up to sell it, let me know. I can email that to you as well. And this is for your clientele that I say when I say baby premium finance, because you traditionally don't see premium finance for the millionaire next door. This is usually for 5 million and above, 10 million, 15, I already mentioned. So this is more for your Johnny Everyman who's got a really good salary. Think of doctors, dentists, attorneys, CPAs, and they're okay paying the 50% premium for the 5 years. After they're done with that, they're good to go. But you have to prove that you have W-2 or K-1 income of 100K or higher to even qualify financially for this type of solution. So those of us who deal with certain industries where they like to show that they're cash poor, but we know they make more, this might not be a vehicle that they can work in because of the fact that their financials are going to work against them in that standpoint. So we look at traditional premium finance, and this is where you typically see those $10 million face amounts, okay? So you look here, we have a 45-year-old male, preferred best, $10 million. And here you see the annual premium being financed is $632,000. The projected interest rate, once again, this was earlier this year, so it'd probably be a little bit higher now, like 6-7%, around that ballpark. But the client in this scenario has a little bit more liberal time in picking exactly what they want to do in regards to paying back. For example's sake, the client contribution actually matches the client interest. And so the projected interest they're paying themselves. And what we noticed there was that I'm borrowing $632,000, as you can see in the first column. I've paid 29,415, which is a projected interest. That's also what I'm paying for the contribution. But what you'll notice is there is a loan balance of 632,587 at the end of the year, which leads to a difference that I have to have, or that collateral I was talking about being put into a bank liquid and sitting there, because the difference between the cash value and the loan balance that I borrowed, there's a gap of 121,000. Now, you'll also notice years 5, 6, and 7 are what you call the danger zone. That's when the collateral is the highest it possibly is. What you'll also notice is the client contributions. If you actually added those up over time, those 15 years, it comes to roughly about half of what the client would be paying from premium finance. So when you think about it, that other one, the 3-to-1 leverage, actually has a better story because you're only paying half for 5 years, not the full 10 in this scenario, or in this case, the client's paying for 15 years. Now you'll see that they will pay back the note of 6.325, which is the total loan balance by the end of year 15, using the cash value from the policy. You have 9.6 million, it drops to 3.9 because you borrowed that money. But now you have literally $4 million at your fingertips that you can use however you want. Whether you want to keep the death benefit up around that $14 million mark, let it grow, borrow it, use some for income, retirement income at that point. But this is, once again, an idea for a clientele who have a net worth of over $5 million. They can do the Kaizen plan. but we have more flexibility and options once you get to a higher face amount. And they're willing to pay at least the interest or more per year. As a agent, what I would say is I would highly recommend paying 20, 30, maybe even 40% if you go this route, because I would rather have my money going into the policy versus going into a collateralized gap that has to sit in a bank account. So just kind of think about that for when you're going up and looking at these strategies. There's another unique way you could do it. So, we were talking to a client at one point where they said they had a total of 750,000. We decided we would front it in the first 2 years, so the premium would be about 545. And instead of spreading that 750 out over time, the loan repayment section, we have 375,000 for the first 2 years. And if you look over at the cash surrender value net of loan, there's only 1 year where we actually have collateral of $36,000. Now going down to year 15, we pay the note back plus the interest, and then the client had about $1 million a year in income that they could produce off of that. So they also had a death benefit purpose. As you can see, by 85, they still have about $10 million in death benefit or net death benefit. They've pulled out, what is it, 15 years, 20 years of $1 million. So that's not bad too. 20 million of income and still a $10 million net death benefit. So that's the kind of stuff that you can look at from a premium finance perspective. Now, what I'll share with you is we'll go to the actual Kaizen site. And what I will do is I will use myself as an example for running an illustration or a presentation. And so we use our company, National Life Group. That's one of the companies. And we'll say, for example's sake, this is what a client would get every time you send them an invite from this Kaizen platform. An intro, they could watch the video. Then we go to estimate my benefits, where they could actually play around with it, how much they want to contribute based on their age. It's a little slider, but we'll go custom design today. And I'm going to say new custom design, and we'll put in my information, Phil Resch, 12/22/1981, and male, and we'll pretend I'm average health. So no nicotine products here. I'm technically 42, even though I'm 41 today, next month, little birthday. So we can look at it two ways. One, maximize the death benefit, or two, maximize distributions. So if I want to take this from an income perspective, I would click on this. And let's say, for example's sake, they show the minimum of 21,350. But let's say, for example's sake, I want to put in about $50,000 a year for the next 5 years. We're not going to do any employer match contributions right now, but we're just going to kind of go forward and click next. I'm going to say income from 65 to 90, and we'll hit view results. Which, by the way, if you guys didn't have a chance to read the old newsletter, you can actually do this Kaizen in monthly premiums now as well. They have changed it. I have not got boned up on it yet, so I'm just telling you now. I'll do my research and let you know how it looks from that standpoint. But that is very, 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 very unique when it comes to premium finance. You pretty much never see that. So, very interesting take on that standpoint. Once again, as this is estimating the benefits, if you have any questions, feel free to put them in the Q&A section. So I can answer them either now or throughout the presentation or after the presentation is over. And so what you'll see is my contributions here, my little orange piggies is what I'm contributing. And then the green ones are the bank. So you'll see they're going to put in about 34,000. And then after 82,666, awful number. And what it's going to equate to from a benefit standpoint is about a 7.84% return. I have initially about a $1.5 million death benefit, and I'm able to pull out starting at 65 for 25 years, $91,000 or $2.366 million and tax-free income overall, with still almost $1 million of death benefit after. So if I open up the actual illustration, let's look at the client proposal first. So as we all know, interest rates have changed since what I just showed you on that screen. Some people will say this is too good to be true. Well, I tell you the reasons why this is advantageous. One, the bank wins. Why? Because they're letting you borrow money. That's why they're going to give you 3-to-1 leverage, because they're going to get all their money back plus interest. That's how a bank makes money. Two, the insurance company wins because they're not doing just the 12 months policy expenses. They're putting excess premium in, so that's more money for them to invest in options. And lastly, the client wins because they're getting extra leverage on this strategy. And as you can see here, if we use the same parameters, a growth rate of 6.42, an income tax rate of 37%, long-term gains, everything equal, if you just use an after-tax investment, you get 47K, self-funded 64K, so a typical IUL. Or if you use the leverage, you're getting a bigger death benefit at death and more income. And the important thing about this little sheet that I love is that they also stress test these policies to make sure that the performance still lasts. So 1980s, what happened in 1980s? The illustration, or excuse me, the interest rates went all the way up to 15%. Well, if they went all the way up to 15%, guess what? You still make money. That's your income. And if the Great Depression hits again, and there are 9 out of 15 years of absolutely zero returns, or zero is a hero, you still make money. So there are still opportunities for you to get cash accumulation, growth, and income from these type of sales. And they show you that in this with the stress test. So you'll see here, your interest rate now, 7%, but we're anticipating a drop. Usually that happens when there's a change in government. So we can anticipate a drop or change in the interest rates. Once again, you'll see my 50,000 I'm borrowing here, or I'm using here, but I'm borrowing here. I'm going to give back the total note by year 15. And then you'll see the entire time net illustrated death benefit. So I will have a net death benefit roaming around $1 million for a majority of my life. And then also, National Life Group has living benefits, chronic, critical, and terminal. So I'll still get those if I have an accelerated death benefit concern. And I'm still getting income here. So as you can see, it's a pretty cool story. And if you want to see the actual illustration, you have it here. And you go through the process. You can see, I call it the money page, where they show everything for example's sake. And your income. So everything is there. Now, if your client likes this, they like the opportunity because they've been playing around with this, they can go through, see the whole story, obstacles. So this is why you have a 30% split with Kaizen, because they give you all of this at your fingertips. And if the client's ready to roll, they hit enrollment, they hit get started, and then they actually fill out majority of the application. Then it's sent to you as the agent to fill out your part. So I say all this once again to tell you that there are some perks to premium finance. Don't get me wrong. When you talk to clients, is there a cool way that you can position the conversation? Mr. and Mrs. Client, have you ever heard of a bank finance retirement strategy? What's that? Premium finance, but I'm just using different terminology. So it's a different way you can bring up the conversation. And plenty of times I've had conversations about, tax-free retirement strategies, leveraging banks for those higher net worth people who can afford it, that I know can afford it. And then, we talk about it. They say, I don't really want that bank note. So I say, fine, let's just do a normal one. And then they end up doing a normal one. So plenty of different ways that you can go from here. It just depends on how you want to set it up. So I'm going to pause now, see if anybody has any questions, and I will stop the recording.